Hi, this is Nate Williams, and I'm here to talk about something very exciting with you today: financial statements, accounting. This is the official Practice Financial Group financial statement review. Now, as many of you may know, accounting is the language of business. Let that sink in for a minute. Accounting, as geeky as it sounds, is a language. And it's a way to communicate to managers or investors or bankers or anyone who has an interest in a particular business. It's a structured way to communicate information, particularly to communicate financial information about what's happening inside the business. The more you understand accounting, the better you understand business in general, and particularly the more easily you'll be able to communicate with other people about what's happening inside a business. And particularly, it'll give you a greater understanding of your own business. So, in an accounting system, information is gathered about all of the different transactions that occur in the business: buying equipment, buying supplies, collecting cash as revenue, making a debt payment. Anything that happens, any transaction that happens, the accounting system captures every single transaction and organizes them in a fashion that can then be produced as what are called financial statements. These financial statements are like a report that communicates information. Different financial statements communicate different information. The first financial statement that we're going to be talking about today is called the Statement of Revenue and Expenses, also known as a P&L, or profit and loss, also known as the income statement. Why are there so many different names? I don't know. But all of these are synonymous terms, and they all communicate one thing: the collections or revenue of a business minus all of the expenses, which leaves the net income at the end. This is a snip, a visual snip from a profit and loss statement that our firm prepares. And I want to introduce you to the different columns because you'll need to know what these different columns mean. On the left, you have a description of the item. We start with all of the income items, so practice collections, refunds, and net collections, which is gross collections minus refunds. Down below, we would get into the expense sections of the profit and loss statement, where we would talk about employee salaries and dental supplies and lab and rent and other expenses of the practice. So that's on the left, a description of the item. Right next to that is the current month. This month says December, so these financial statements were prepared in January for the prior month. And you can see this practice in the month of December collected $152,307.90. To the right of that, we've got year-to-date collections. Now, if this were a March financial statement prepared in April, year-to-date would be January, February, and March. Because it's December, the year-to-date is the whole entire year. So you can see practice collections were this for the month of December, but for the whole year, the collections were $1,932,926.88. Minus $15,000 of refunds gives a net collections of $1,917,000, etc. Then right here, these percentages, and you'll see these down below in the income statement, we show everything as a percentage of the collections. So a lot of things in the practice, we gauge whether that's good or bad, or the expense is high or low based on how that thing is as a percent of collections. So for example, you might want to know that your rent is 5% of collections or 8% of collections. So that's what this percentage is right here. Next to that, we're going to have this number that says goal percentage. Now, once you have your first annual consultation with us, we will customize the goal percentage for you. Now, just so you know, there isn't such thing as an average practice. practices are all over the board. Think of like a scatter graph, and you could maybe draw a line down the middle, but that doesn't necessarily mean that that's average. Average is what your practice is. It's like, what's the average weight of a human being? Well, average weight might be 150 pounds, but you've got people who weigh 400 pounds down to people who weigh 8 pounds when they're first born. So what's average? This goal percentage is what we're targeting and shooting for your practice, and that's what's important. Right next to this in column 4, we've got the prior year-to-date numbers. This is really helpful to be able to see where the practice is this year compared to where it was last year at the same time. You can see in this particular practice, the total net collections have grown 15% from last year. This is really important. You can see how you're doing over time. So that's just a quick overview of what the statement of revenue and expenses, aka P&L, looks like. So here's a little bit more that you want to know about the P&L. This is what the structure of the P&L looks like, the ones that we prepare. We start with the collections up top. Then we focus on direct expenses, aka variable expenses. Now, variable expenses or direct expenses are expenses that go up or down with collections. For example, dental supplies. If you produce nothing in your practice, your dental supplies will be zero. But if you produce a lot, you're going to burn through a lot of supplies and your dental supplies will go up. Now, the first expense that we list is the employee costs, and we lump these under direct or variable expenses. Now, in full disclosure, employee costs are really not variable. If you hire 3 employees and they come to work today, you're going to be paying those employees whether you have patients or not. So you could argue that the employee cost is a fixed cost, and that would be a very good argument. But the higher the collections goes over time, the more people you're going to have. And so you could argue that it's a variable or direct cost because it's going to rise over time with collections. That's also a good argument. Who's right? Is employee costs a variable expense that it rises and falls with collections, or is it a fixed cost? The answer is they're kind of both right. Employee costs is an example of what we call a laddered expense, where it's flat for a period of time, and then as collections consistently rise and are consistently higher, you hire another person, so it jumps up to another level. So it's more like a staired expense rather than a true direct or variable expense, but it's also not fixed either, right? If you hire 2 people with a startup practice and then you grow that to a $2 million a year practice, you're not going to be able to do that with those same 2 people. So, but the reason we put it here is because it's the biggest and probably the most important expense that you have on your whole P&L. So we chose to put it here with direct expenses so that it's front and center first for you to see. Supply and lab. The reason that this is so important is because we want you to put your cost-cutting efforts here. Now, throughout the course of this video, I'm going to be intermixing the rules of the game or just information with some strategy of how to be a better practice owner. And that's what this is. Supply and lab is simple. You do a crown, you have a lab bill. You do another procedure, you're going to use some supplies, right? But we want you to place your cost-cutting efforts here. If you're looking at your practice and thinking, where am I going to cut costs? Generally, supply is a place that people can quickly blow a lot of money. After the direct expenses, we get into administrative or fixed expenses. So we've got fixed and discretionary administrative expenses. So the fixed administrative expenses include your facility fees, anything related to the building. And other fixed would be like computer or technology expenses, insurance, accounting fees, bank charges, phone and internet, those types of things that are just fixed. You need them to practice. They're not really going up or down. And that's where these go right here. Then you've got discretionary administrative costs, which are like advertising, continuing education, uniforms, things that are more fixed, but they're not really necessary to the business. So advertising, now you could argue that it's necessary, but you could also argue that it's not necessary. So we just break these out right here, and we've got the fixed admin costs and the discretionary admin costs. After that, we get this number right here that's really important called the operating income. So the operating income, remember this, is collections minus all of the overhead expenses, direct and administrative overhead expenses. Okay, this gives you the operating income of the practice. So the reason why this number is so important is because this is your salary. If somebody has a job where they're a W-2 employee and they're making $250,000 a year, that's their salary. If you're a business owner, your operating income is your salary, which is just very simply collections minus all of the overhead costs of the business. After this, from the operating income, we subtract things like the owner-doctor expenses, so doctor wages, family wages, auto expense, health insurance, things that aren't operating expenses of the business, but are more perk-type expenses to the doctor. The other thing that's subtracted below the operating income is any taxes, any debt service, and the corresponding interest. All of that is deducted below this operating income number, okay? So a really popular number in dentistry is EBITDA, earnings before income taxes, or excuse me, interest, taxes, depreciation, and amortization, EBITDA. EBITDA is simply your operating income minus a reasonable salary or a fair market salary for the doctor who's doing the work, okay? That's EBITDA. Operating income minus a reasonable fair market salary for the doctor. Moving on about the profit and loss. I mentioned this earlier, but in there we've got the gold percentage. Remember that no two practices are the same. The important thing isn't that your practice is just like someone else's practice. The important thing is we're going to set goals that are relevant to you. What is good for you might not be the same for somebody else. And that's what we want to focus on. The other thing that I want to really emphasize to you is that most costs in a dental practice are fixed. If you hire employees and those employees are now part of your team, their salary is really a fixed cost. Because if you tell them all, hey, I'm not going to pay you all for a while, they'll go and get other jobs. You need to provide work and you need to pay them or they'll leave. So that's kind of a fixed cost. Your rent and everything related to the building is a fixed cost. The equipment that you need to buy, in the corresponding debt service, that's all fixed costs. So in a dental practice, the vast majority of the costs are fixed. Why is that important? Because it helps you understand that saying your overhead as a percentage of collections is misleading. Saying that my overhead is 60% of collections, that is a misleading statement. Your overhead might be 60% at that particular collection level, but if your collections go up, your costs aren't going up also by 60%. Your costs are going to stay mostly fixed, and so your profitability will go up. If your collections go down, your costs are going to stay fixed, so your profitability would also go down. A more accurate way to describe the expenses of a practice would be to say this statement right here. My expenses are X dollars per month of fixed costs plus X percentage of collections as a variable cost. For example, the expenses of your practice might be $50,000 a month just to open your doors, plus 12% of your collections. That would be an accurate statement. It's really important to know that because a lot of decisions are made thinking, well, my practice kicks off 40% profit margin, or it has a 60% overhead. So if I were to go and get another practice, I would get another 40% profit off of that practice. But that's not how it works. Why is this important? More about this. It helps you understand that the key to profitability is to maximize collections with the fixed cost structure you already have. And it also, understanding this gives you a much needed red flag when you're considering adding more fixed costs, such as upgrading your building or hiring a new person. Be careful, you're going to drastically change the fixed cost structure and you'll drastically increase the required amount of dentistry that you need to do before you end up making any money. I want to talk for a minute about operating a profitable practice. This is really important. I'm even going as far as to make a statement to say that a profitable practice is key to a good life. What do I mean by that? Do I mean that being rich is key to a good life? No, that's not what I mean. Do I mean that if you don't make a lot of money, you won't be happy and you won't live a good life? No, that's absolutely not what I'm saying. What I'm saying is that you only have a certain amount of dentistry that you can do in your lifetime. There is a fixed number of crowns or braces that you can put on in your whole life. You can't produce forever. And so a wise doctor will try to keep in his or her own pocket as much of their labor as they can. And I just think that that's a really important part of a good life. It's like climbing a mountain. Do you want to climb a mountain on a sturdy path, or do you want to climb a mountain in sand? Which one of those is a better experience? Dental practices have big fixed costs. They do. I have already talked about this. The key to being more profitable is not to focus on lowering expenses, although I'm a big fan of lowering expenses when you can. The key to operating a profitable practice is to focus on growing collections. That's the key. Keep supply costs down. That's an important tip. And when you can, and when it's feasible, to drop PPO contracts and go fee for service. This is so important that I want to talk a little bit more about it. How do PPOs destroy the profitability of a practice? First of all, I'm going to compare two practices, a fee-for-service practice with a PPO practice where the doctor collects 65% of what is produced, okay? In the fee-for-service practice, if the doctor produces 1.5 million plus hygiene, whatever, total production is 1.5 million. If it's fee-for-service, they're going to collect 1.5 million. But in a PPO practice, in order to get the $1.5 million of of collections, you need to produce $2.3 million of production to get the same 1.5 collection. So you need to produce $800,000 more just to get the same amount of collections. Now that's a huge headwind, right? But that's not where the story ends. Most of the cost structure in a practice is built around supporting the amount of production that you do. So let's say that employee costs are 23% of production. Now we talked earlier, these aren't a perfect variable cost, but they're also not a fixed cost. So let's just say, for the sake of our example, that 23% of production, or 23%, that employee costs are 23% of production. In order to produce 1.5 million, it's going to cost you $345,000 of salaries to support you to be able to do this, okay? Just hypothetically speaking. And let's also assume that the supply or lab bill is the combination of these two is 12% of production. Now, I'm just pulling these numbers out of a hat, but every practice is going to be different, but you get the idea. So in order to produce 1.5 million, you're going to have $180,000 of supply bill. And the fixed cost of this practice, $250,000 a year, let's just say. So the total expenses for this practice are $775,000. Okay, so in this fee-for-service practice, you produce 1.5, you collect 1.5, your expenses are $775,000, and your operating income is $725,000. That's pretty good. But now let's go ahead and look over at the PPO practice, where you have to produce 2.3 million to collect the same 1.5. But also, you're going to have a lot more in employee costs and supply bill because you're still paying 23% based on production, not collection. It's not your employee's fault that people don't pay. They still have to help you do the work. And so you can see that the employee costs and the supply costs are going to be much higher in a PPO practice than they are in a fee-for-service practice. Now, the fixed costs are going to be the same in either one. The rent expense doesn't care. Your rent doesn't care if you're fee-for-service or PPO. It is what it is. So in this practice, you've got $1,057,000 of expenses on $1.5 million of collections. So the operating income on this practice is $442,000 compared to $725,000. So going fee for service is a really big deal, or being in network with PPOs is also a really big deal. It's like having the big headwind of the production, or excuse me, not or, but and you're dragging something behind you. So imagine you're riding a bike into a big gale of a headwind, but also the rear brake on your bicycle is broken and it's rubbing against the tire. That's having a PPO practice. Let's move on a little bit and completely shift gears. I want to talk about the cash flow report, or the statement of cash flows. This is another important financial statement. And this is a financial statement that we prepare for our clients. And what this does is it shows you exactly where all the cash went. We have doctors ask all the time. They say, hey, I earned $50,000 this month, but I don't know where the cash went. The statement of cash flows tells you exactly where all the cash went. And you can see, so here's January 2024 statement of cash flows. And you can see that the ending cash in December, $67,279, becomes the beginning cash of the next month in January, $67,280. So we're off by $1 here. And then from there, this is what you begin in the January 1st. You start with $67,280 plus collections minus the direct expenses, which is employee costs and supplies, minus the administrative expenses. And then here's a small amount of interest paid on the loans. And here's some debt reduction, right? So the combination of these are the debts paid by the practice. You can see this practice is very little debt. Gives you the cash available for the doctor. And then here's the doctor's salary. Here's some draws plus investments that the doctor made. Here's some perks that the doctor paid. Here's a contribution to the 401k profit sharing plan. And then this is an adjustment, the cash adjustment for the credit card. Sometimes you rack up bigger expenses on the credit card, but you don't actually pay the bill. And the next month, you might not have the expenses, but you pay the bill. So there's an adjustment here. And so this shows the ending cash for this doctor. So that's the statement of cash flows. If you get to understand this statement, study it for a bit, it'll tell you exactly where all the cash went. Next, we're going to talk about the balance sheet very briefly. This is the accountant's financial statement. Now, for those geeky souls who want to understand what the balance sheet is, the balance sheet shows what all of the assets of the practice are, and then it shows how the practice owns those assets, which is either through debt or loans or equity. So the debt plus the equity always equals the assets. Assets, liability, and equity. So a really important accounting equation is assets equals liabilities plus equity. So these are some important components of the balance sheet. The first one is assets, and the first asset we list, cash. Very important, right? I'm not going to talk about cash right now. We've got a whole other video, and we can talk a lot more later, but cash is listed at the very top of the balance sheet. Next, we list all of the equipment. I want to just talk a bit about strategy when it comes to equipment. Yes, we want you to invest in your practice. If you have the ability to increase your profit, your production, and increase the value that you can add to your patients by buying more and new equipment, we would say go for it. But here are some important things to consider. First of all, we never recommend that you buy equipment for the purpose of getting a tax deduction. If you're thinking, I'm going to buy this equipment to get a tax deduction, that's a bad reason to buy the equipment. The next thing is doctors are kind of suckers for buying new equipment. It's the new shiny thing that everybody wants. And so we recommend when you're considering making a significant purchase, we recommend waiting at least 3 to 6 months to see if you still want that thing and if it's still going to be an important part of your practice. I can promise you there are a lot more doctors who have buyer's remorse about equipment than there are doctors who have, I didn't buy the equipment and now I'm remorsing. We almost never hear of this. We hear a lot about the buyer's remorse for those who are have the guts to confess that. When you're ready to buy equipment, we also recommend that you take a minute to shop around, shop different deals, and to see if you can get equipment used. There are a lot of doctors who buy equipment and then very quickly realize that they're not going to be able to incorporate it into their practice. And so the dental practices of America are full of lightly used equipment for people who bought too quickly and weren't ready for it. That's enough about equipment for now. The other thing that the balance sheet shows is all of the loan balances of the practice. Very, very important. And we track these month by month. What is the balance of the loans? So if you ever want to know, hey, how much do I owe on this? You can go to your financial statements that we prepare for you on a monthly basis, and you can look at the balance sheet. Page 2, it shows every loan that the practice has. Moving on, I want to introduce you to a really important thing we call the trends graph. The trends graph basically is a snapshot of the profit and loss over time. This blue line up here, and here's a key down here, but the blue line shows the collections of the practice, okay? This orange line is the projected collections, what we have projected that you will collect in your practice. And most importantly, we're basing your financial plan off of that. We're also basing your tax projection off of that. So that's what this orange line is. You can see this month, this doctor exceeded the collections goal. And this month, the doctor significantly underachieved the collections goal. The yellow line is the operating income. The red line is the projected operating income. And this green line is the expenses or overhead of the practice. So the yellow line equals the blue line minus the green line gives you the yellow line. And you can see this yellow line mostly follows the blue line. And that's because for the most part, the collections stay relatively flat or fixed. So that's the trends graph. This is, if you're wanting to look at your financial statements, this is the first place that I would go just to get a quick snapshot. How am I doing over time? Now I want to get into a really important thing that we'll send to you every month in the accounting email. When the Practice Financial Group accounting specialist who works on your account finishes your monthly financial statements, he or she will send you an email saying, I am done with your monthly financial statements. And in that email, they're going to take a snip of a few important things. The first one is the cash surplus plan. This cash surplus plan will tell you exactly what your surplus cash is. Now, if you watch the other video, if you understand this, the only relevant piece of data right here is the prior month. So if I'm looking at this in the January 2024 financial statements, then I'm looking at this hopefully during the month of February 2024. Now you can see there is not a surplus this month. So that's kind of disappointing, kind of boring. But if we go back to October, if I were reviewing this in November for the month of October, you can see there was a $5,683 surplus. That's very important. As soon as I see that surplus, I then look down here and ask, what am I going to do with the surplus cash? And this is what you do. Here's priority number 1, priority number 2, priority number 3, and so on and so forth. And you're just going to follow those priorities. These priorities are what we set with you in your in your financial planning consultation. Another really important part of the monthly accounting email is this tax planning component. So right here in that monthly email that you get, it's going to show you some details of the most recent tax projection that we did. It's going to show you the projected tax liability for the current year that we're in. So this says most recent tax projection was done in December 2023, but this is for the 2024 tax projection. So we're projecting that this doctor is going to owe $48,000 in taxes, $34,000 for federal plus $14,000 for state. And then here we're showing what you're with. Right here we show how you're going to pay for these taxes. Right here it shows we're going to withhold $63,458 through payroll. And so we're expecting a big refund at the end of next year. So probably need to adjust this individual's tax projection. Okay, that's what this is right here. It tells you how much you're going to owe in taxes and how you're going to pay for those taxes. So really pay attention to this right here. The next thing that you'll see down below that is a summary of the projected income for tax planning purposes. So this is actually a snip from the profit and loss statement. Now, this shows right here the operating income for the practice. This is the current month, and this is the year to date. So you can see that the current month is same as the year to date. So this snip was taken from January, where the current month and the year to date are the same. And then this right here shows the projected operating income from just the current month, or from the year to date. So we take the year to date divided by the number of months that are included and multiply that by 12 to annualize this number to get to this. So 44,000 divided by 1, because we're looking at 1 month, times 12 gets us 536,000. So far, this doctor's on pace to have $536,000 of operating income for the practice. Now, the prior tax projection that we did based on 12/31/23 assumed that the operating income for the practice would be $450,000. So if we're on pace to do 536 and our last tax projection was 450,000, this right here shows the over or under. We're $86,000 ahead of what our last tax projection was. Now, that's really great. That tells, now you know that you're $86,000 ahead of schedule. You're overshooting what our prior projection was or goal for you was. But when you're over, that just means you're going to owe more in taxes than what this tells you up here. I hope that makes sense. So you've got year-to-date collections, or operating income. This is the annualized operating income, or what we're projecting for the whole calendar year. This is what our prior tax projection assumed. And then this tells us if you're over or under. So if you're over, that means awesome, you're overshooting your goals, but you're going to owe more in taxes. If this number is negative, that means you're not doing as well as we previously thought you were going to do, but you're not going to owe as much in taxes. So what should you do when you get this monthly accounting email? Here's the bare minimum. Review the monthly accounting email and follow the surplus plan. If you do that right there, that's great. If you want extra credit, you can review the financial statements, which will tell you more about where the money went, and you can get into the details of how the practice is doing. And if you decide to do that, I would start first with the trends graph. But just so you know, a little disclaimer, this accounting system and cash surplus system, cash management system that we've put in place for you by design, requires very little oversight from you. We have on purpose tried to make this very easy so you can focus on other important things like patient care, the actual dentistry, and leadership in your office and your personal life. This wraps up my talk about the PFG financial statement review. I hope this has been helpful. If you have any questions, we can't wait to hear from you. Thank you.